Welcome to the Boardroom Report, your weekly pulse on the seismic shifts in business, technology, and policy that demand your attention. Let's dive in. First up, and this is a big one, the United States just captured Venezuelan President Nicolas Maduro. On January 3rd, U.S. military forces launched strikes against targets in Caracas. Maduro and First Lady Cilia Flores were taken into custody and transported to DEA headquarters in Manhattan. He appeared in federal court on January 5th, facing drug trafficking and narco-terrorism charges under a newly unsealed indictment. President Trump stated the U.S. will, quote, run the country until such time as we can do a safe, proper, and judicious transition. Now here's why this matters for your portfolio. Venezuela sits on the world's largest proven oil reserves, 303 billion barrels. That's roughly 18% of global oil reserves, 6 times larger than what the US has in the ground today. But here's the catch. Production has collapsed in Venezuela. In the late 1990s, Venezuela was pumping 3.5 million barrels per day. Today, around 800,000, less than 1% of global supply. Decades of mismanagement and sanctions have gutted the infrastructure. PDVSA, their state oil company, admits pipelines haven't been updated in 50 years. So what's the investment case? Rystad Energy estimates it would take $110 billion in capital investment over the next decade to rebuild Venezuelan production. The payoff? At current prices, those reserves are worth an estimated $17.3 trillion. And here's the detail that most people miss. U.S. Gulf Coast refineries were specifically built to process Venezuelan heavy crude. It's ideal for diesel production. The market is already pricing this in. Chevron, which operates about a quarter of Venezuelan production, jumped 5%, Halliburton surged nearly 8%, SLB popped 9%, and the Dow hit a record 48,977. A key catalyst to watch is the transition timeline. Analysts think production could grow by a few 100,000 barrels per day within 12 months under stable conditions, but a meaningful recovery? That's a 5+ year story. And there's $190 billion in outstanding foreign debt that needs to be restructured before major investment can flow in. Bottom line, this is a generational infrastructure opportunity, but execution risk is also enormous. From oil infrastructure to AI infrastructure. At CES on Monday, Jensen Huang unveiled NVIDIA's next-generation platform, Vera Rubin. And the surprise? It's already in full production ahead of the second half of 2026 timeline everyone expected. Let me give you some of the numbers. Compared to Blackwell, NVIDIA's prior generation platform, Vera Rubin delivers 5 times faster inference performance, 3.5 times faster training, and the big one is a 10x reduction in cost per token. That last metric is critical because inference costs are what's holding back enterprise adoption. A number of parties have already committed to purchasing Vera Rubin, including Microsoft Azure, AWS, Google Cloud, Oracle, CoreWeave, Lambda, Nebius, plus hardware partners Dell, HPE, Lenovo, and 80 others. AI labs including OpenAI, Anthropic, Meta, and xAI are also expected to be among the early adopters. NVIDIA expects $500 billion in combined Blackwell and Vera Rubin revenue through the end of 2026. The Wall Street consensus remains a strong buy, with price targets on NVIDIA in the $262 to $275 range, implying 40% upside from the current levels around $188. The key takeaway? NVIDIA isn't just maintaining their lead, they continue to accelerate it. Speaking of leads, Tesla just lost one. On January 2nd, Tesla reported Q4 deliveries of 418,227 vehicles. That's down 16% year over year and missed estimates. For the full year, deliveries fell 8.6% to 1.64 million. That's the second consecutive year of decline for Tesla. And here's the big headline. BYD, the Chinese EV competitor, delivered 2.26 million in pure EVs in 2025, officially overtaking Tesla as the world's largest electric vehicle maker. So what went wrong? Well, a few things have converged. One, the $7,500 federal EV tax credit expired on September 30th, which pulled demand forward into Q3. European registrations fell 28% as backlash against Musk's political involvement continued, and Tesla's lineup is aging in a market that's getting more competitive by the quart. However, it's not all bad news for Tesla. Tesla Energy hit record deployments up to 14.2 gigawatt hours in Q4. And if you believe the robo-taxi and full self-drive trajectory, the vehicle numbers become less relevant to the overall thesis. Dan Ives at Wedbush called the result better than feared and maintained his $600 price target on Tesla. The bull case now rests almost entirely on autonomy and AI, not in EV unit sales. From EVs to ETFs. On Monday, Morgan Stanley filed with the SEC to launch spot Bitcoin and Solana exchange-traded funds. This is the first major U.S. bank to seek approval for direct cryptocurrency exposure products, not just distributing third-party offerings, but building their own. So why does this matter? Morgan Stanley's wealth management arm oversees $1.6 trillion in assets. By launching proprietary ETFs, they can vertically integrate crypto products into client portfolios and keep management fees in-house rather than paying them to BlackRock or Fidelity. The Solana product is particularly interesting as it would allocate a portion to staking for additional yield on the ETF. That's a structural advantage over simple spot exposure. For context on the market, US Bitcoin ETFs now hold $123 billion in total net assets. Net inflows have topped $1.1 billion since January 1st, and Bitcoin recently rallied above 94,000, its best start to a year since 2021. This follows December's OCC clarification allowing banks to act as intermediaries on crypto transactions. The regulatory moat that kept traditional finance on the sidelines is crumbling. Morgan Stanley's intro into the crypto markets is strong for the overall bull case that crypto needs to be a part of the standard allocation in portfolios, not just a speculative sideshow. Semiconductor stocks rallied hard to start 2026, and memory makers are leading the charge. Year to date, Micron is up 16.3%, Samsung is up 15.9%, SK Hynix 11.5%, and the Taiwan Semiconductor Company's ADRs hit a record $319, pushing market cap to $1.66 trillion. What's driving this? The AI training boom is creating a severe shortage in high bandwidth memory, the specialized DRAM that goes into NVIDIA's chips, as an example. Memory prices surged throughout 2025, and Counterpoint Research expects another 40% increase throughout Q2 2026. Samsung and SK Hynix are reportedly seeking 70% price hikes for server DRAM in Q1. When suppliers have that kind of pricing power, margins can really expand dramatically. Samsung alone is expected to report a 160% jump in Q4 operating profit, and Micron's CEO said they expect to meet only half to two-thirds of the demand from key customers throughout 2026. The key takeaway? Memory was really the boring part of the semiconductor stack for years, but not anymore. High bandwidth memory is now a strategic choke point, and the companies that control it have pricing power they haven't seen in decades. Finally, the macro backdrop. On Sunday, Minneapolis Fed President Neel Kashkari, who rejoins as a voting member this year, said the Fed may be pretty close to neutral. Translation is the rate-cutting cycle might be nearly over. The Fed funds rate currently sits at 3.5% to 3.75% after the 175 basis points of cuts in 2025. According to December's FOMC projections, that's only about half a percentage point from the committee's consensus on the neutral rate. Kashkari's logic is that over the last couple of years, they kept thinking the economy was going to slow down, and the economy has actually proven to be far more resilient than originally expected. That's basically been signaling to the Fed that monetary policy must not be putting that much downward pressure on the economy. One more thing to watch is that Fed Chair Jerome Powell's term actually expires on May 15th. Trump is expected to name a successor sometime in the next month, and markets are currently pricing in just 1 to 2 more cuts for all of 2026, with January expected to be a hold. Overall, the implications are that the era of easy money that fueled the 2023 to 2025 rally may be winding down. However, things will become much more clear when we see who President Trump selects as Jerome Powell's successor. That's your Boardroom Report for the week. Thanks for watching, and if you enjoyed, consider leaving a like and subscribing to the channel. This is Boardroom Wire. See you on the next one.